People like to say, money makes the world go round. But if you look at history closely, you see something else. Money can also make the world lose its mind. Imagine selling your house just to buy a flower bulb. Imagine fortunes being made and destroyed in days, not because of war or invention, but because everyone convinced themselves something was worth more, simply because the next person would pay more. From tulips in 17th century Holland to NFTs in the 21st century, bubbles tell the same story again and again. When greed takes over, reason quietly leaves the room. And every time people say, "This time is different," it never is. To understand bubbles, you first have to understand something uncomfortable. Wealth is psychological. A bubble always starts with a promise. Quick riches, freedom from the grind, a shortcut. At first, it feels logical. Prices rise because demand rises. Investors feel smart, early, visionary. Then momentum builds. More people rush in, afraid of missing out. What's being traded almost doesn't matter anymore. Land, stocks, railroads, internet startups, digital images of apes wearing sunglasses. The only thing that matters is this belief. Someone else will pay more tomorrow. At its core, a bubble isn't about real wealth. It's about the illusion of wealth. And illusions eventually break. Take the Dutch tulip mania in the 1630s. Holland was wealthy. Amsterdam was a global trade hub. People had disposable income. When tulips arrived from the Ottoman Empire, they were exotic and rare. Owning unusual varieties became a status symbol. But then, something shifted. Tulips stopped being flowers. They became financial instruments. People weren't buying them to plant. They were buying them to flip. By 1636, tulip futures were being traded. At the peak, a single rare bulb could cost more than a skilled worker's yearly income. Some sold for the price of a house. And then, in 1637, buyers stopped showing up. Confidence cracked. Prices collapsed almost overnight. The Dutch economy survived, but many individuals were ruined. The lesson was simple. When price detaches from usefulness and survives only on speculation, the fall is inevitable. The pattern repeated in Britain with the South Sea bubble. Huge promises, trade riches, government debt converted into shares, stock prices exploded, even elites and intellectuals jumped in. Sir Isaac Newton himself lost money, and later said he could calculate the motions of the heavens, but not the madness of people. That line still says everything. The 18th and 19th centuries saw railway manias, land booms, gold rushes. The 1920s in America brought easy credit and stock speculation. The crash of 1929 didn't just hurt investors, it reshaped the global economy. In the late 1990s, it was dot-com stocks. The internet was real, but valuations weren't. Companies with no profits were worth billions. When the bubble burst, trillions vanished. In the early 2000s, it was housing. People believed home prices could only rise. Complex financial products turned mortgages into ticking time bombs. When they exploded in 2008, the entire global system nearly broke. Then came crypto and NFTs. Bitcoin started as an experiment. What followed was massive speculation. Prices surged not because of widespread use, but because people believed someone else would buy higher. By 2021, crypto felt unstoppable. By 2022, over $2 trillion in value had disappeared. Different eras, different assets, same human behavior. Every bubble has two ingredients: Human psychology greed, fear of missing out, the dream of easy freedom, and financial structure easy credit, hype from insiders, systems that allow leverage to spiral. Bubbles don't just happen because people are foolish. They expand because the system makes them possible. And here's the uncomfortable part. This isn't just history. It's happening now. Look at housing markets in major cities. Prices detached from incomes. Look at speculative tech plays. Look at government debt levels. Look at how often you hear, "Don't miss out." The language never changes. Revolutionary. Unprecedented. Once in a lifetime. But there is no permanent financial revolution. Only cycles. Bubbles matter more today because the system is more connected and more leveraged than ever before. In the 17th century, a tulip crash hurt merchants. In 1929, it fueled a global depression. In 2008, housing nearly shattered modern banking. As finance grows bigger, the consequences grow heavier. And there's a deeper layer. Bubbles aren't just about money. They're cultural mirrors. Tulips reflected a rising middle-class chasing status. The South Sea Company reflected empire financed by debt. The Roaring Twenties reflected belief in endless progress. Dot-coms reflected faith in technology. Housing reflected obsession with ownership. Crypto reflects distrust of institutions and a desire for digital independence. People don't just invest in assets. They invest in identity. That's why bubbles are so powerful and so hard to stop. So what does this mean for you? It means you should treat every too-good-to-be-true story with caution. It means understanding that speculation without discipline destroys people. It means focusing on fundamentals, real utility, real cash flow, real value. That sounds boring, but boring is often what protects families. Boring is what builds wealth that lasts. Real wealth is slow. Illusions are fast. History doesn't repeat exactly, but it does rhyme. And it punishes those who ignore it. Every bubble begins with a promise. The promise that this time you can escape history. But history always catches up. So the question isn't whether another bubble will form. It already is. The question is whether you'll chase it blindly or step back, learn from the past, and build something real. Because when the next one bursts, the system won't care who believed the story. It never does. If this gave you a new perspective, subscribe to the channel and like the video. History has the answers. I'll show you where to look.